we thought the pathetic pace of reforms, red tape, political uncertainty and corruption are Indian specialities that are slowing India's growth, maverick economist Nouriel Roubini has a consoling thought. He believes all the BRICS nations are showing the same tendencies.
In most of these BRICS, for the last few years, there has been a very slow process of economic reforms and liberalization. That progress has been mediocre at best, in some cases has stalled, if not reversed. And many of these BRICS are following economic growth models that to different degree are what people refer to as variants of state capitalism. That's very clear, of course, in places like Russia or China, where state capitalism is still dominant, but some elements of it are also occurring in places like Brazil or even India. What do I mean by that, by state capitalism? I mean that not enough structural reform that increase the productivity and the share in the economy of the private sector, a greater role in some cases like China and Russia in state-owned enterprises and their role in economic policy and economic growth, a greater role of state-owned banks in the allocation of credit and in the allocation of savings to investment, resource nationalism and controlling national resources as opposed to liberalize them, slow progress towards trade liberalization and opening up the capital markets and the capital account. If anything, actually some reversals and imposition in some cases of capital controls, and in some cases not only not trade liberalization, but actually outright restriction to trade, import substitution, industrialization, domestic content legislations, and other restrictions to trade in goods and services. Now, if these trends that are in the direction of more state capitalism as opposed to market-oriented reform were to become entrenched, then there is a risk that actually, not only on a cyclical basis, but also on a more structural basis, economic growth in these emerging markets could slow down over time.
Roubini needs to be taken seriously since he was the first to predict the global financial crisis of 2008. Here's what he thinks on a range of current issues.
Dr. Roubini, pleasure having you with us, and thank you very much for joining us on CNBC TV 18.
Great pleasure being with you today.
Well, first of all, so let me start bottom up. Actually, in the last 8 weeks, what has really churned the global scene, asset markets, seems to be the very steep fall in commodities. What does this look like? Is it an end to the super cycle that we saw from 2001 to 2012? Is this the end of financialization of commodities? What exactly are we going through? Is it temporary, or is it that commodities won't get back to the 2012 or pre-2012 levels?
Well, in my view, the falling commodity prices, while being beneficial, of course, to countries like India and others that are net energy and commodity importers, may be actually a signal of weaknesses in the global economy. What has happened for the last few weeks is that most of the macroeconomic news have been actually quite negative and surprising on the downside. First of all, the Eurozone periphery recession is not bottoming out, and now this recession is spreading even to the core of the Eurozone, France, and even the latest data from Germany, forward-looking indicator of manufacturing, have been weak. Secondly, the United States now is slowing down. The effects of increasing taxes and of the sequestration of spending is now having a negative impact on economic growth, slower consumption growth, slower private sector growth, and the fiscal austerity is going to have a negative effect on growth. And now even the data coming from China, is the second largest economy in the world, suggests that in spite of another round of credit fuel investment, the growth of China might be slowing down. Both the first quarter growth numbers and now the forward-looking indicators like the PMI suggest softness of China. So in some sense, if the falling commodity prices is caused by a growth scare, and if it's not just a growth scare, but if we're going to see economic weakness in Europe, in the United States, in the UK, now even in China, that's going to be bad news, because while falling commodity prices benefit commodity importing countries, if the reason why commodity prices are falling is that markets now forward-looking pricing in softer global economic growth, that's going to be bad news for India, it's going to be bad news for Asia, and it's going to be also bad news for the global economy. So it's a mixed bag.
Of course, fair enough. But I'll come back to the growth scare and how secular it can be in a minute. Just a word more on the financialization of commodities as an asset class. You know, one reason why commodities did not fall in the period from 2008 to 2012, despite very big recessionary trends, was because central banks went on printing money, or at least the US Fed did. Now we have actually, the US has not stopped printing money. The $85 billion is coming in every month. And another big economy has joined the bandwagon. You know, if Abenomics was to reach its logical conclusion, Japan would be printing something like $1.4 trillion worth of yen. Now, logically, if there is so much money getting printed, then at least gold should not fall so much. And yet we see gold becoming the worst casualty of the commodity fall.
Well, the reason why commodity prices are falling in spite of easy money is exactly that right now there is a growth scare, and that growth scare might be more than a scare, it might be something more substantial. And the reason why central banks keep on printing money is exactly because they worry about downside risk to economic growth. Now, within the commodity space, of course, there are also precious metals and gold in particular. In my view, the reasons why gold is falling in price are several. First of all, the risk of another global financial meltdown have been receded. The tail risk, for example, of a breakup of the Eurozone are lower. And usually gold tends to do well when you have the risk of a global financial meltdown. That's the time of buying gold, canned food, and running to your log cabin in the mountains if you really worry about another global financial crisis. That risk successfully has been reduced in Europe and the rest of the world. The second reason why gold could go higher is because there could be a scare about global inflation, but the reality is that in spite of very easy monetary policy in the US, in Japan, even in other central banks in advanced economies, the reason why they are printing more money is exactly because growth is so weak, and weak growth is associated with deflationary, if not disinflationary pressures. So in spite of a rise in liquidity, there is no inflation. If anything, these growth concerns imply disinflationary pressures, and therefore holding gold because of worries about hedging as inflation is going away. Third of all, this increase in liquidity now has restored economic growth, both in advanced economies and emerging markets, and there are other risky assets that can give you a greater return than gold, like US and global equities. For example, gold doesn't have any income, doesn't pay a coupon, doesn't give you a dividend like equities, is only based on having a capital gain if gold prices go higher, while equities provide you potentially both a capital gain and a dividend. Bond can give you a capital gain if the price rises, and they give you an income in terms of a coupon. So in some sense, actually, the fall in the price of gold is a good signal, because it says that in spite of the recent concern about global economic growth, there is a global economic recovery, and there are other assets, like real assets, like good corporations in advanced economies and emerging markets, good bonds in advanced economies and emerging markets, real estate, and some commodities that can give you a higher return than something that is, in the past was called a barbarous relic, doesn't have any intrinsic value, and is used only in times in which people are worried about the future. So as they're worried less about the future, maybe there is less room for gold and there's more room for other assets that are more productive assets than gold.
Okay, so let me come back to the issue you raised about the global growth scare, whether it's you know, a phenomenon that is just cyclical, or whether it looks like it will be more long-standing. What is your sense about the US economy itself? We've been getting bad data for the past, what, 3-4 months. Is this just a lull because of sequestering and the budget-related problems, or do you think we're going to have a longish bad phase, and in that case, will that mean quantitative easing continues?
It's a mixed story. There are some positives about the US that are ongoing. The housing recession has bottomed out. The shale gas and oil revolution is going to reduce energy costs and increase employment in that sector. There is some reshoring of manufacturing because labor costs are rising in China. And the third manufacturing revolution is more capital intensive based on robotics and automation. There's been some job creation, and the fact of quantitative easing has led to asset reflation and some boost to economic growth. So the U.S. economy is recovering. The problem is that, however, there is still subpar, anemic, and below trend growth in the U.S. because there is a painful process of deleveraging. Households have still too much debt and therefore have to save more over time, and the increasing taxes now takes a bite on disposable income. The government has to retrench, and in some sense, unfortunately, the fiscal austerity right now is becoming, even in the U.S., excessively front-loaded as we have raised payroll taxes, and as the sequestration implies cutting spending faster than will be necessary and desirable. In the medium term, the U.S. economy probably is going to outperform other advanced economies. Its own fundamentals, both in terms of productivity growth and demographics, are stronger than the Eurozone, stronger than the UK or Japan. But I think that the US faces serious issues of political gridlock, where the two parties divide about the spending, about taxes, about energy policies, about immigration policies. There's broader political gridlock. And there's also the challenge of the Fed, if and when they're going to exit from QE, how they're going to do it. For the time being, quantitative easing and zero policy rates are still warranted by slow growth, high unemployment rate, and high debt ratios. But the risk is that if you keep this liquidity for too long and you exit too slow, eventually you're going to create frothiness and bubbles in credit markets, in asset markets, in equity markets. So we may be actually facing a repeat of what happened in the cycle between 2004 and 2008, when the real economy justified keeping rates for longer, lower, and then normalizing those rates slower, because the real economy justified going slow. But in the meanwhile, we created a huge bubble in credit, in subprime, in housing, in inequities, and that boom and bubble eventually ended up into a bust and a crash. I do worry that actually this same cycle is going to occur right now. The real economy is weak, unemployment rate is high, debts in the private and public sector are still high, so the Fed has to keep rates at zero for still a couple of years and then normalize them very slowly. But there is already beginning of frothiness in credit and asset markets, and another 3 to 4 years of low rates and normalized very low could actually lead to another big bubble in credit and in equity markets, and that bubble eventually could lead to a bust like we observed in the last cycle. So that's one of the dangers the US is facing right now.
What are you advising your investors at this juncture? Are you asking them to stay put with developed market equities? I mean, we did see some weaning away of money from emerging market equities into developed market equities. What is the advice you're giving? What would be the asset class you would chase if so many of them are showing weakness? What would be your top 3 asset classes?
Well, first of all, the effects of liquidity, easier monetary policy by the Fed, by the Bank of Japan, Swiss National Bank, Bank of England, soon enough even the ECB, should be sustaining asset reflation in risky assets like US and global equities. On the other side, however, valuations right now are stretched, even the US. After all, the stock market is more than 100% higher than it was at the bottom in March of 2009. So price-earning ratios are somehow high, and the slowdown of the economy implies that earnings growth is going to slow down. So I think that for equities, there's going to be this tension between slowdown of economic growth being negative for profits and earnings, and potentially leading to a correction, but then easy liquidity and the search for yield still sustaining those asset prices at levels that are higher than justified by those fundamentals. And certainly, advanced economies, equity markets recently have been outperforming emerging markets, in part because there was these effects of liquidity, in part because growth has been actually somehow disappointing in China and India, in Brazil, in Russia, in South Africa, and other emerging markets. Therefore, for the time being, I would say that tactically you might want still to be long risky assets like US and global equities, but right now there's a risk that this growth scare of the last few years, a few weeks, may be becoming something more than just a growth scare. It is not just a scare, but it leads to a significant slowdown of growth. We already have seen the effects of it on lower commodity prices. We've seen the effects of it in terms of the EM equity markets underperforming the advanced economies, and the net leg of it could be a correction of equity prices even in advanced economies, starting with the US, if this is not just a growth scare, but rather something more serious, and that's a risk that we do face.
Okay, I believe we are running out of time. A final question on India, since you would have studied it very closely as part of your BRICS analysis that you presented today. There have been some long-term macroeconomic corrections in terms of the fiscal deficit being brought under control, and that probably having a benign impact on inflation. But you know, our savings rate is 30%. Even with a capital output ratio of 4, we should still be running at 7%, but the economy is growing at 5%. What are you diagnosing as the problems? Are you still positive on India as an asset class, equities? What would you look forward to?
Well, on one side, there are many positives about India. You know, it's a large country that relies more on domestic demand rather than at exports. There is a kind of a population demographic dividend. There is a sophisticated business, industrial, corporate, and financial sector. And, you know, potential growth could be much higher than it is right now with the right economic policies. I think that the fact that in the last couple of years growth has been really disappointing, slowing down last year to less than 5%, this year might be barely 6% plus, when a few years ago was as high as 9%, is driven first of all by the fact that there are still meaningful macroeconomic issues that have to be addressed. Inflation rate is still too high, the budget deficit is still too high, the current account deficit is large and is a source of risk. And the slowdown of growth has been in partly depending on the fact that the process of structural reforms of economic liberalization for a while was frozen, and even now is occurring at a snail's pace. You know, India is a great country being a democracy, but of course in multi-party coalition governments, accelerating reforms that are not agreed upon by every member of a coalition occurs more slowly than is otherwise desirable and optimal. And I think that unless India deals with accelerating the structural reforms, what's going to happen is that even if you boost growth in the short run by easier monetary and fiscal policy, you're going to face supply constraints, because there are supply bottlenecks coming from not enough infrastructure, by not enough electricity and power, and therefore if you increase demand without increasing supply through structural reform, then inflation goes higher, and every time inflation goes higher, then the Reserve Bank has to control inflation that is socially and politically disruptive by tightening monetary policy, and that slows down growth again. So you have this yo-yo of overheating, acceleration of growth, higher inflation, followed by policy tightening, and then slow down of growth below potential. In order to stop this kind of cycle of up and down, you need to actually accelerate the structural reform that's going to increase potential growth, so that if demand grows faster, it can grow faster without causing excessive inflation. So those are some of the challenges that India has to face over time.
Dr. Roubini, I'm afraid we have run out of time. Thank you very much, sir, for joining us today.
Great pleasure being with you today.
Thank you, sir.
Thank you.